Good evening, Mark and Lauren, and thank you for spending some time with me this evening. I wanted to have this virtual interaction with you as we had recently reviewed the financial plan I had prepared for the two of you, and you wanted to get a little bit more rationale as to some of my recommendations, specifically within the retirement plan portion and the estate plan portion of your financial plan. I want to first begin by saying thank you for your honesty and your openness with me, as we've had a variety of discussions about many of your personal desires and personal wishes for not only your financial affairs, but just really how you want things to happen in your lives and in your children's lives as well. It very much helps me as a financial planner to have those discussions and give you the best advice I can. You both have done an excellent job of accumulating a great deal of wealth, and with Mark looking to retire this year, all signs point to a very successful retirement for Mark based on the income that he would desire in retirement. It's a great thing to be in that position, Mark, and I would have to say, not only can you feel confident with the income that you're desiring to have, but you also may have some flexibility to spend a little bit more. As you had maybe noticed in the financial plan I prepared, you have relatively a surplus of about $1 million just based on the resources and savings that you have in your name applied, or having the income applied to those savings over your lifetime. Now, something else that we want to make sure to include obviously would be Lauren's retirement goal in the next 5 years. And with her desired level of income, she also has a great chance of retirement success when she retires at 55 and when you would be age 70, Mark. So between the two of you, you definitely have a nice little cushion in retirement. Now, with the recommendations I provided, I wanted to make sure to go over those briefly. Primarily, the recommendations for Mark revolved around the tax implications of selling his business this year. And because of the capital gains implications, a key component is making sure you both have sufficient cash and funds available to pay those taxes this year. And that's why I really recommended that Mark have $180,000 in cash to cover those anticipated taxes this year. Now, the other thing to be aware of, Mark, in retirement is we want you to be spending down cash and not having to tap into your portfolio unexpectedly to raise more cash for your retirement expenses. Therefore, I recommend that you have $200,000 of your existing cash available to you, thereby allowing you to easily withdraw that balance over the next 12 months and allowing your portfolio to perform as designed, as I recommended in the investment plan portion of your financial plan. Additionally, I had recommended, Lauren, that you really don't have a need to save more in your 401k plan. However, I feel like this year it's warranted to have you contribute the maximum of 16% of your salary toward your 401k plan, as this will not only increase your retirement savings this year and give you some flexibility, but also it will reduce dollar for dollar your taxable income in 2016. And this will help both you and Mark with the higher level of taxable income you both may realize this year, which may subside in subsequent years. The second part of our discussion this evening was going to revolve around your estate plan. And the two are very interconnected. And the one thing I would leave you with on the retirement plan side is you have some spending flexibility. Just looking at the estimates and the forecasting we've done with your desired level of income, you both have some ability to increase that, but just be careful with that, as by increasing your income in retirement, if the assumptions we use may change, or even if you desire to accomplish other financial goals, you may compromise your chances of being successful. And so with your estate plan, really that's something that right now is a point-in-time view of where things are. And that's certainly going to change as you spend down your savings and spend down your resources over the next 20, 30 years. The big item that I happen to see that I really want to make sure we addressed in your estate plan was the significant level of assets owned by Mark. And if Mark was to pass away, I want to make sure that the assets that he owns are transitioned tax efficiently and transitioned in a way that are going to meet your personal estate planning goals. One of the elements of estate planning is marital planning, and with a lot of the assets that Mark has, those are going to transition to you, Lauren, automatically as far as the insurance policies and with the IRA plans, those will go to you automatically. Now, the thing that really can help Mark is to take advantage of the federal estate exemption amount. That amount in 2015 is $5,430,000. And so what we want to do is have some of Mark's estate use that exemption and have the remainder passed to you, Lauren, as estate tax-free, essentially. The way that I recommend that you do that is by using a bypass trust for Mark's taxable assets. And what that means is those assets would be counted toward Mark's estate exemption. They would go into a trust where, Lauren, you would be the income beneficiary and can also use the principal if necessary in certain circumstances. But upon your passing, Lauren, those assets are not included in your estate calculation, which is a benefit to you. Otherwise, if that was not the case, you may have a very significantly elevated estate, and there could be a chance where you may be subject to estate tax. I don't want that to happen, and I think we can avoid that by using the bypass trust. In addition, I feel it's imperative that your wills also reflect your wishes as accurately and as in a coordinated way as possible. The Q-tip trusts that you both have identified in your wills are typically used to take advantage of the marital deduction, will also take advantage of specific legacy and family planning. Now, based on the fact you've shared with me, you want to make sure that each of you receives a very significant amount of each other's estate while having your 4 children as secondary beneficiaries equally. Based on your desires to make that happen, what I recommend that you do, as opposed to using the Q-tip trust, is to have your wills become pour-over wills, meaning anything that is not left to either one of you outright as a beneficiary of an IRA or other type of plan, or through the titling of the assets like your home and automobiles, for example, as joint tenants, anything that's not covered by those designations is to be included in your will and to be transferred into your irrevocable trust. And the reason I feel like that's beneficial is those assets can pass along to the trust where your 4 children are primary beneficiaries, and their children may be beneficiaries if one of them has predeceased you already. And that way it allows those assets to be administered in a way that you feel is appropriate in that irrevocable trust while still being transferred as smoothly as possible. So those are really some of the recommendations I had outlined for the two of you. I hope you find them valuable, and from what we've discussed, I feel like they're really going to help you accomplish what you're looking to accomplish, both with your retirement plan and with your estate plan. Now, of course, there are other things that we can certainly discuss, and if you have any questions regarding my recommendations or anything we didn't discuss this evening, please feel free to reach out to me. I'd be happy to spend more time with you, either virtually or in person. Once again, it's been a pleasure working as your financial advisor. I look forward to working with you in the near future.